Well, welcome back to my Super Bowl, baby. When it comes to earnings, I get really excited because it's a defining factor to valuations in the market. And on this rocket ship up, Friday is where the devastation came in, where we went from all this green back down to the red. And I really want to discuss it with my favorite stocks, what I might consider buying here, and the mix between like Canadian earnings and US earnings, because we did have some resilient Canadian stock post pretty record numbers. But when you take a look at XEQT, VOO, VDY, everything is selling in tandem. And I think it's quite hilarious because it's on jobs numbers that I just don't think are that bad, or at least that's what people are saying, right? And when you look at the spattered performance this week, Nvidia's up, Microsoft's up, Meta's up, but my God, Google, Apple, Amazon, companies that were posting astounding numbers are absolutely tanking. In the Canadian economy, you're going to notice that it's the industrial services that we're going to talk about here when it comes to Enbridge. We're going to talk about Ford. Some of the utilities have been on absolute tear on their recent earnings, but even still, the financials and everything else kind of getting dragged a bit. Non-energy still up on the mega cap side of things when it comes to gold, silver, the precious metal explorers. And when you scroll through your watch list, I'm sure depending on what you use, like finding green is sparse today, like little in between at all. I mean, the only thing that I saw was Enbridge, which is now giving up a lot of its gains. I'm surprised Bell is up as much as it's up. A little bit of green in some of the dividend players out there. Pepsi, Verizon, Fortis is the one that I want to talk about. They did a great job on earnings. Unilever's up 2.88%, but otherwise, man, it's not looking too hot out there this week. And again, they're claiming it's because they did some adjustments to the jobs reports. They added 73,000 jobs, but unemployment remained a bit sticky and up to about 4.2%, which you think might be a bit high. And you're like, oh my goodness, they're claiming that unemployment is continuing to spike up a little bit. But when you zoom out on the long chart, guys, yeah, unemployment is this little thing here in the 2020s era where we kind of came out of the pandemic, everyone went back to work, and we've kind of just slightly increased from being at 3.5 to about 4.2, like nothing that I think would be overly concerning, considering we're in job markets that are more comparable to like the 2000s or even the 1970s or 50s, where employment was basically, unemployment was sitting between like 3.5 to 4%. Like this is one of the greatest markets in the entire world, and everyone's just hoping this is an excuse for the Fed to cut rates. I don't know. I don't understand how people are trading this into the market when earnings were that resilient. I mean, we did see some of the tariffs take effect on Ford. Ford stock is trading down a bit on earnings, but they were basically posting virtually no profits at all, as apparently it cost them $2 billion, from the tariffs, but they had a record revenue. They just couldn't actualize any real profit. It was like 0.8 billion or 800 million, I think was net or whatever was that negative. But yeah, they're just saying it was all a huge portion of that was the net tariff related impact. So it's going to be neat to see how this kind of adjustment takes effect as Trump continues to make tariff deals. They're saying that's part of this. Honestly, I think it's just a healthy correction. I really think this was something that was just necessary, and it's opening up the door to better valuations. And like I said, there's nothing better than earnings going up, stock prices coming down. This is going to get me back into a market where I'll be more comfortable and probably get a little bit more aggressive with buying. And I just want to talk about mega caps. We'll talk about some of the Canadian dividend players out there. But when I looked at mega cap earnings, it just solidified my position in Google even more. I think Google should be the largest company on the planet, and it doesn't take a genius to figure out why. I mean, you look at Amazon, which I don't think really deserved to be hit as hard as it was hit. I mean, their net sales went from 147 billion, almost 148 to 167. Net income from 13.4 billion to 18 billion. Like these numbers were incredible, but what was really, I think holding them back a little bit here, what always continues to hold them back, Amazon's the only company I don't like in the mega cap realm just because they keep diluting. They don't have to dilute, but they make profit. Why are they continually diluting shares and pulling capital off the markets? Unless this is compensation. I haven't looked too deeply into it, but these are diluting up to 3% can be pretty extreme on the reflection of stock growth, right? But people are also saying it's guidance. Their guidance is a bit mixed considering their operating income is expected to be between 15.5 and 20.5 billion. So they're basically giving you a range that's right in the middle of the 17.4 billion they posted in the third quarter of 2024. I'm going to estimate they're going to crush this. Everyone's going to be probably pretty conservative because they like crushing guidance numbers. I mean, that's what gets the stock to explode. I will say this is the first turnaround period I think Apple is finally seeing. Apple's been flatlining for some time, and this is the first time their revenue is starting to go somewhere, yet it's not reflected in the stock price. But I think it's just too expensive, guys. At a 31 PE here, a company that is only just starting to get a bit of growth back, going from basically 85 billion to 94 billion, which is great. Obviously, you want to pay close attention to the net income numbers that went from 21 to 23 billion. We're finally starting to see a turnaround in iPhone sales from 39 billion going up to 44 billion. The only thing really giving them any material growth, though, is iPhone and services. Everything else is basically flat or down, but services grew by like $3 billion. So, I mean, services, I think, is going to be the leading future of any growth that Apple's going to really experience, because how much iPhone growth can you really have? I mean, I think we've reached parity with the market at that point, and these numbers are kind of reflecting it. Microsoft, we've talked about their earnings. Their earnings smashed it. It was great, but again, they posted net income of 27 billion. And I do want to again reiterate that Apple posted numbers here, again reiterating that Apple posted net income numbers of 23 billion versus Microsoft's 27.2 billion. And if we go back to Amazon here, Amazon only posted a net income of 8 billion. And the reason I'm hitting this so hard over your head is because Google today is worth less than Amazon. It's worth less than Apple's $3 trillion valuation. It's worth less than the $4 trillion valuation Microsoft almost has. It's trading at 2.29. Amazon's trading at about 2.31 trillion. And I just want to iterate that Google did $28.1 billion in net income. Google did more net income than all these companies, yet trades half as much as Microsoft's worth and is growing just as, insanely. I mean, their growth rates for their net income was like double digit at the like 20 percentile range, right? And, Microsoft, it's basically growing at the same pace that Microsoft is, and it's making more net income. I just can't get over that. So like I'm sitting here looking at Google, and honestly, I'm pretty happy with the performance today, because it really goes to show like Google's only down 1.6% right now. I figured it'd be down a bit more than that, but it's kind of in line with how much the S&P's down. Meta's only down 2% after that historic run up. So there's a reason that I really like Google. I still really like Meta stock, and Google's going to remain one of my largest positions moving forward until this value gets recognized, because every quarter they're growing double digits. But oh my God, guys, search revenue is going to go away. It's not going to be here forever. It's going to be a declining business, yet it just reversed and started going up more than it was previously. Like every negative I hear, it just gets completely disregarded every single earnings period. So I feel like it's just a matter of time. On the Canadian side of the border, I'm very excited for bank earnings to see if we can keep up. I'm really hoping Canada can solidify its higher valuations that exist in the market. We've talked about this. The broader Canadian markets actually trade at higher values in the US, 20 percentile range, but not nearly the same kind of growth rates. Even VDY is trading around a 14-15 price to earnings multiple, which is pretty rich for the growth rates that we're getting out of it, but still a lot more modest than perhaps, the tech companies and some of the other companies that have been really driving up the valuations, like Enbridge here trading at a 23 PE, but is doing great on earnings. The stock's flat. These are the kind of stocks that I would just own to make a return off the dividend income. So buying it on dips is usually the most opportune thing you can do. I love Enbridge. I think people keep forgetting the scope and scale. This company's building renewable projects with Meta to help build out some of their data centers and AI centers. We've talked about the insane pipelines this company runs. It is the largest pipeline company in North America. It is the bloodlines that basically run our lives. And if you just take a look at their earnings, they were great. Adjusted EBITDA 4.64 billion, up from 4.335. All these numbers look pretty resilient across the board. If you're into kind of gas transmission, that was where the real growth came from in midstream, probably from some of the acquisitions, because we knew oil prices have been down. They've been fluttering kind of up a little bit, playing in this new range. But overall, liquid pipelines was basically flat, just down slightly. But everything else, with the exception of renewable power, was up. I mean, gas distribution and storage went from 567 million to 840. Overall, these numbers are exactly what you would expect from a company like this. They've done an exceptional job, and I'm shocked to see like Fortis and some of the utilities kind of coming out of their their hiding hole, because these companies were flatlining for like 5 years where they just really didn't do a whole lot of anything for shareholders. And now we're in like this new bull market. Fortis is, it's up 16% year to date, absolutely crushing it. The earnings weren't anything like that astonishing overall, but the second quarter net earnings were 384 million versus 331 million, which is kind of showing a new earnings growth rate for some of these companies. And I think some of this is the resilience of the interest rate recovery plays I've discussed when it comes to these heavily infrastructure oriented companies, and them finally living in a lower debt environment, at least on the Canadian side of the border. Fortis does have U.S. and Canadian exposure, but I really feel like these companies are going to start to benefit even greater. If you look at their balance sheets, and same with Enbridge, right? These companies are sitting on heavy amounts of debt. 47 billion versus 73 billion in total assets, right? So, if we look at Enbridge comparably, how much comparable debt. I know Enbridge is primarily operating off massive, massive amounts of debt here. Let's just take a quick look. Yeah, I mean, 150 billion in debt versus 218 in total assets, right? So, I mean, what is that? 68 billion in underlying asset value, where you gotta service this insane amount of debt. So these companies should start to benefit, especially on the Canadian side of the border. But the U.S., we still need those interest rate cuts. I'm really excited to see how that takes effect on the market, because it should just be ever more bullish for these mega cap companies that have proven, regardless about how you feel about jobs, tariffs, AI taking your job, whatever, these companies don't care. They are literal rocket ships when it comes to their bottom line earnings, and you cannot help but continue to be exposed to them, even at the higher valuations that exist in this market. So again, valuations are going to start to come down a little bit if the market keeps correcting. These earnings should solidify you to be buying regularly and not changing your cost average strategy, or even maybe getting a little more aggressive with companies you feel are undervalued. For me, like, that's Google. Obviously not financial advice, but I will pass that question off to you. I'd love to know what you guys think about all of this in that comment section below.